Thank you all for joining us. It's my pleasure to welcome David Miller, Chief Investment Officer of Catalyst Mutual Funds based in New York. David is a Wharton graduate and he's had more than 10 years of experience in public equity investing as well as building companies. While still at university, David founded Bitcentives, a company designing software for mid-market internet retailers. David was also the CEO of Movie Days Media Group, a search engine marketing company that he co-founded in 2003 and sold in 2006. At Catalyst Mutual Funds, which he co-founded in 2006, David specializes in value-oriented strategies that produce income and equity-type returns at limited risk. Today, he will focus on the insider-driven strategy in small and micro caps and show us how to use insider transactions to profit as an outside investor. And with that, David, please take it away.
Thank you, Oliver. So our philosophy at Catalyst, especially regarding small caps, is pretty simple. It's that the top executives who are running the firms themselves give you the best indicators as to whether you should be buying or shorting that stock based on whether they are buying or selling that stock heavily with their own personal funds, excluding any stock option or restricted stock activity at that particular firm. We've found some enormous alpha to companies that have examples of heavy insider buying where everyone's buying substantially with their own money, where there's at least 3 executives buying at least 10,000 shares of stock with their own firm. We found those companies dramatically outperform the market on average in the subsequent year. And where those companies that have dramatic insider selling where no one's buying, those companies on average substantially underperform the market in the subsequent year. We think these findings are very intuitive, given that no one could possibly know what a company is worth and where it's going and what's happening at that firm nearly as well as the top executives actually running that particular firm, especially in small and micro cap stocks where they frequently have little or no analyst coverage, so nobody's properly building out the models to project the free cash flows for those firms. So the only people who really have any clue as to what those firms can be worth in many examples are those top executives who actually are privy to the order book and privy to all of the information at the company. So I'm going to give you some basic disclosures. There's no assurance that a fund will achieve its investment objectives. Investors should carefully consider the investment objectives, risks, charges, and expenses of Catalyst funds. This and other important information about the Catalyst funds is contained in the prospectus. The prospectus should be read carefully before investing and can be obtained by calling Catalyst funds. Now I'm going to give you some of the basic philosophy behind how insider activity can be tracked. So there's provision in Dodd-Frank which changed the requirements for insider disclosures, whereas insiders previously had to disclose all of their transactions to the Securities and Exchange Commission in their own company's stock in less than a month and 2 days following the transaction. Under Dodd-Frank, they now have to do that within 48 hours of the transaction. This gives us some incredibly fresh information about what the insiders are thinking about where their company is going, where we really have very little delay from the information as it's actually processed in the insider's personal transactions. So what we've found where there's the most value to looking at these transactions is something called cluster activity. We found that approximately 90% plus of insider activity is completely irrelevant. If you look at the 13F filings, the filings by the largest shareholders, there's very little alpha to those types of transactions. If you look at the 10b5-1 plans, where the executives are putting in place a plan where they do not actively buy or sell stock that's done under a preset plan, those plans have little alpha when you look at them directly. If you look at the stock option exercises at a particular firm, we found there's actually negative alpha to the purchases. And that's likely because when an insider is about to exercise stock in the firm where they're working and buy it at a below market price, that means they're likely to be selling the stock in the very near future. The place where we have found that there is dramatic, substantial alpha to the strategy is when you look at the companies that have heavy insider buying by multiple insiders simultaneously, all purchasing with their own personal funds at an at-the-market price through open market transactions. Or conversely, we have found that those companies where they're all selling their stock simultaneously in a very heavy fashion, where nobody is buying, those companies historically have dramatically underperformed the market. We have found that this isn't just particular to whether or not they're buying or selling, but the actual seniority of those insiders within the firm. We have found that largest shareholders, those who are technically insiders because of the amount of stock they own, actually have the least alpha. Just because you see some large pension fund or private equity fund buying or selling the stock, it doesn't mean that they necessarily have incredible special information about what's going on at that firm. Next, we found that the directors have the next most alpha. However, they still have substantially less than the people actively running the firm on a day-to-day basis. Following that, we've seen that the top executives, the C-suite officers, have the most alpha by far, and whenever they're buying unanimously or selling unanimously, it's a good idea to listen. On top of that, we've found more intuitive findings that just kind of make sense. The larger the transactions, the more alpha there is. The more stock that you see an executive buying, the more alpha historically there is following those types of transactions, while conversely, the more stock they're selling, the more alpha you'll see following those transactions. We have really found that the saying that there's only one reason that insiders buy holds true. Well, there's many reasons that they sell. However, there is a substantial degree of alpha to both of those strategies if you track the insider's activity directly. We found that there's 11% alpha to firms that have clusters of insider buying with no selling, and then there's 4% alpha to those firms that have clusters of selling with no buying. So essentially what we do at Catalyst is we filter through those hundreds of thousands of transactions that come through the SEC filings with our software to determine which firms are the best buy candidates and which ones are the best candidates to sell short, so that we can build a hedged portfolio so we do not need to depend upon the market going up to be able to make money. We just need the companies where the insiders are buying to do better than the ones where they're selling. And we've found historically that that works remarkably consistently. It's actually pretty rare for insider buying to not outperform insider selling in any given year in recent memory. If you were to build a portfolio of long and short stocks where you're long the ones with the heaviest insider buying and short the ones with the heaviest degree of insider selling, you would have done quite well on a very consistent basis. And we've modeled that and found you would have dramatically outperformed both the Russell and S&P indices by building this type of portfolio, but you would have also done it with dramatically less volatility than those indices while blowing out their returns with an outstanding Sharpe ratio. To give you a little detail, we found that if you just built out a portfolio where you went 100% gross long the companies with the heaviest degree of insider buying, and then you subsequently went 50% short the companies that had the heaviest degree of insider selling, you would have put up pretty astounding returns. You would have been up 252% between 2005 and 2011, whereas that generated a 19.7% annualized return for you, whereas over that same time period, the S&P 500 was up only 0.6% annualized, and the Russell 2000 index was up 2% annualized. When you look at it on a Sharpe ratio basis, you have a Sharpe ratio in excess of 1 and a Sortino ratio of 1.42 for this type of strategy versus the S&P 500. There have been over 20 strong academic studies that have supported the conclusions that we've come to, that there is substantial alpha to insider activity. Some of those have have examined the transactions in many different ways, and they've all generally had the same findings when they exclude option activity, that there is substantial alpha to insider activity. We found some of the best studies were done actually by a professor that I studied under named Nihat Sehun, who's a preeminent expert in insider activity, and wrote a book called Investment Intelligence from Insider Trading, where he'd studied the topic extensively from the 70s through the 90s, and had determined how much alpha there was from insider activity by the level of officers and directors, by the number of shares traded at the firm, by the unanimity of the activity. He specifically reviewed cluster activity, where it was unanimous buying by multiple executives or unanimous selling by multiple executives. And across all of his findings and the findings that we've seen both at Wharton, Harvard, University of Michigan, and a number of other academic studies, there's been conclusive academic evidence that there is a substantial degree of alpha to just simply tracking insider activity directly whenever it's done unanimously in a substantial fashion. So we've found that that activity, where I explained earlier that there was alpha, to by a number of different intuitive or logical reasons for analyzing it. We've seen that there's very little alpha if you look at companies that have 1 to 100 shares purchased, only about 1% alpha, where it kicks up to about 4% alpha when you see insider purchases at that company between 100 and 1,000 shares, and then it jumps up to 6.4% if you look at the companies that have 1,000 to 10,000 shares purchased by their top executives. And if you include the companies where you are looking at the largest shareholders, when you look at the 10,000 plus transactions, 10,000 plus shares, there's only 3.9% alpha. However, if you only look at the firms where it's all top executives buying and you exclude the activity by the largest shareholders, there's in excess of 10% alpha simply to tracking those transactions that have dramatic insider buying activity. If you were to look at a chart of how insider activity performs, we've seen that it's pretty unique. You'd have a downward charting slope in the several months prior to insider buying occurring, whereas historically the absolute bottom on average for any company is actually generated by the place where there's the largest inflection point of insider buying activity. So they're quite good on average in the aggregate at timing the bottom for their stocks. And then in the months subsequent to that, you would see on average those charts reverse and start trending upwards pretty dramatically following the purchases by those top executives. So now to give you a couple examples of how this has worked historically for our funds at Catalyst, and then a couple recent examples. I think one of the best in recent memory is from Zynga. They came public with a $10 billion market capitalization. Really wanted to get out of the firm stock because they only had about $1 billion in revenue at the time. And there was a lot of hype surrounding the upcoming Facebook IPO. And the insiders at Zynga realized that their revenue growth had been decelerating at the time, that there was not enough of future in the firm for them to possibly justify a valuation anywhere close to $10 billion. And yet the insiders were locked up in their stock until the end of their restricted period. In this particular example, the top executives of Zynga were in such a rush to get out of their stock, given that they realized that there wasn't a whole lot of bottom to the share price, that they went to some pretty dramatic means. They created a secondary transaction for the company, which enabled them to get around the Securities and Exchange Commission's rules for not selling in the first 6 months following the transaction through that secondary offering. And whereas you typically raise money for the firm itself through the secondary offering by selling treasury stock, in this particular example, it was pretty much all the top executives selling their own personal stock, and there was dramatic selling in that regard. The CEO of the firm, Marcus Pincus, sold over $192 million worth of stock. Ben Nada Owen, director at the firm, sold 88% of his holdings. John Schappert, the chief operating officer for the firm, sold 83% of his holdings. The CFO of the firm, David Wenner, sold 66% of his holdings. And another senior VP, Reginald Davis, sold 86% of his holdings. If you look at these examples, they just go on and on for Zynga, where all of the top executives were in an enormous rush to get out of their stock, and for good reason, because the company was about to miss earnings in a substantial fashion in the upcoming quarter following that secondary transaction where the stock dropped from the secondary offering price of about $11.60 a share all the way down to the $2 to $3 share price range where it trades today. So whenever you see an example like this where it's not just one or two executives selling, and it's clearly not just for tax reasons or the personal motives of one executive, but where all of the executives across the board are dumping the majority of their stock simultaneously, it's one of the best indicators that you can find for a company that you really want to go short. And it was actually our best short position or best position period for Catalyst in 2012 because of the dramatic insider activity at that particular firm. We found also in 2012 that you got some great examples of companies where you could go both short and long the same firm at different times based on tracking insider activity by top executives at those particular firms. One of the best examples of that type of activity is Green Mountain Coffee. Green Mountain Coffee traded up to nearly $100 a share after they'd experienced some substantial revenue growth over a period of years, where at that point several executives started selling their stock in a substantial fashion. David Einhorn, the hedge fund manager, came out with a 120-page report on why you should sell the company's stock short. Now, the top executives at that particular firm, Green Mountain, verbally disagreed with his report that said that you should short the stock because their accounting was borderline fraudulent, that their revenue growth was unsustainable, and that their margins from their deal with Starbucks were not going to be particularly attractive. Now, while those executives were verbally disagreeing with David Einhorn's report, they were also selling their own stock personally in a very heavy fashion, close to $100 a share, which tripped our short selling triggers when we see that type of dramatic insider activity. And we found that some of the best examples are where you can either go long or short a company is when top executives' words differ dramatically from what they're doing with their personal funds. Green Mountain Coffee is definitely an example of that, where they were talking the stock up and defending it while dumping their own stock in a very heavy fashion simultaneously. And it's not too surprising that the company's shares dropped from near $100 to $22 a share when it was found that David Einhorn was pretty much on par with most of his accusations against the firm. And those insiders made a lot of money by selling their stock close to $100 a share, along with David Einhorn, who made a pretty good bit of money by shorting it. So the company was interesting because they called the top for the stock, and they created a great signal for us to go short. But where it got even more interesting is when all of those top executives who were actually running the firm reversed direction in their own stock, and David Einhorn covered his shorts. They all reversed direction in a very substantial way when the stock got close to about $22 to $24 per share. So if you were looking when you saw the stock actually start to hit close to that price, you would have seen a dramatic reversal in insider activity, whereas previously, especially in May of 2012, you would have seen dramatic unanimous insider selling in a heavy degree at Green Mountain Coffee. Starting in August of 2012, you would have seen all of that activity reverse, where everybody at the firm stopped selling. There was no more selling at the firm. And then you would have seen a wave of insider buying by 6 different unique executives who were all buying in a very heavy manner, totaling in the millions of dollars. Virtually the whole board had bought at the firm. You also saw the president of the firm buying at the same time. And there their purchases ranged from about $21.57 a share all the way up to $24.61 per share. Now, once again, they were quite prescient in their timing when the stock beat earnings by a wide margin and ran up nearly 70% to the mid-30s per share, trading all the way up to about 37 when you saw another reversal in insider activity and they started selling. So we took our profits on both the short and long positions in Green Mountain Coffee, where we made some pretty significant money on both sides of the coin trading that particular firm. Now, to keep looking on with that, we've seen a good example where you see that type of activity as in Weatherford International. The stock currently is trading only about 0.6 times sales, whereas the rest of the industry is trading about 1.3 times sales. They've got a price-to-earnings growth ratio of only about 0.65 versus about 0.92 for the industry average. Now, Weatherford had some interesting issues with their taxes. They had some tax and filing issues that had continued for a couple of years up through about 2011 that had really started to impact the stock price. They filed a notification for their late filing in November, Form 12B25, due to some tax-related issues for why they weren't going to be able to file in a timely fashion. And you would have noticed shortly after that filing that the stock dropped dramatically. Now, following that filing and the stock price getting hit in a big way, you would have seen another cluster of insider buying led by the VP of tax at the firm. Now, you would think that there's probably not a lot of good reason to be too concerned about that tax filing after you saw that the VP of tax started buying stock in a very heavy fashion with his own personal funds after experiencing the price drop at the firm. And ever since then, we've seen the stock rally from about $10 to $13 a share following the purchase by those top executives. And we think that once those tax issues at Weatherford are fully resolved, the stock will be able to likely rally a good bit further. One of the most recent examples that we've seen activity in, very recent as in actually this February, is in a firm called Computer Programs and Systems, CPSI. CPSI isn't really an example of a reversal in particular. It's just an example where the company has seen a pretty heavy wave of insider buying, whereas they had some mixed activity back in 2011. Starting this year, on February 5th, we've seen a big purchase by John Douglas, the CEO of the firm, where he recently bought $194,000 worth of stock. We saw a similar size purchase by the CFO of the firm, David Dye, and then we've seen another large purchase, $172,000 worth of stock by Michael Muscat, the SVP of Product Development. Now, these purchases follow some purchases that they had at the stock back in May as well, and we think you're likely to see some substantial potential alpha in computer programs and systems based on that large cluster of unanimous recent insider buying at this particular healthcare technology firm. So just to summarize, we've got a pretty simple philosophy at Catalyst. We think it's worked quite well. It's very straightforward. You just go out there and buy all the companies with the most insider buying, short the ones that have the heaviest degree of insider selling, that you can beat the market by a pretty wide margin pretty consistently just by following insiders' activity. That there isn't necessarily as much value to doing research as you would otherwise think, given that it's very hard to do enough research that will get you to the point that you could potentially know more than the CEO, CFO, chairman, or many of the top officers or directors at that firm, no matter how much you look into the industry, no matter how much you research what's going on at that particular company, no matter how much you do macroeconomic research, the top executives at that firm are always going to know more than you possibly could. So if you just simply mimic that activity when you see it in a unanimous, extreme fashion, you can beat the market returns offered by the S&P 500 by a wide margin with dramatically less volatility. And I'll turn it back over to you, Oliver, for any questions.
Well, David, thank you so much for these comments. Fascinating presentation. I'd like to refer anyone in the audience with questions for David to get in touch with him directly, or to post any questions in our online conference area for David. I have a few questions myself. David, just curious if you could talk a bit more about the approach, how it works in a portfolio. If we look at, for example, CPSI here, for this strategy to work, how many positions do you typically have? And do you do any further fundamental research, let's say, on this CPSI, or is it all contained within the insider strategy, so it's part of a basket approach, and CPSI just performs a certain function within that overall basket for you to generate alpha over time?
Sure. Thank you, Oliver. So what we've found, ironically, is that you actually do a good bit better in most companies if you completely ignore everything externally and coming up with any external opinions or doing any research on the firms themselves, and you just rely directly off of the insider activity, because they tend to be better informed than any other investors that we have met. And where the examples occur in the most dramatic fashion is where, looking at everything at that firm externally, there's nothing that would make you want to buy the firm other than the insider activity. Companies where you see scandals, tax issues, potential legal issues at the firm, lawsuits, companies where you just keep digging and you just see more problems. The firms where you see that type of problematic activity combined with heavy insider buying are some of the firms where we've seen the best recent examples of excess performance from buying those types of stocks. And some of the absolute best alpha we've seen from selling short companies is those companies that look the best on an absolute basis externally, where everyone is writing up the company in publications, where they're beating earnings by a wide margin, where the stock is seeing a substantial run-up, and yet all the top executives are selling heavily into those firms. So if you simply look at the firms where there's the biggest divergence in activity from what you see externally versus what you can see that the executives are doing internally, those have been the best examples for us. And it's not just specific to individual companies themselves either. It's very true for the market as a whole. If you look at insider activity in the aggregate, it's been remarkably predictive of where the market's about to go in the near future when you see that there's heavy insider buying across the market, or when there's heavy insider selling for the market as a whole. It's a strong negative indicator where the probability of an up market following a big wave of insider buying is dramatically higher than the probability of an up market following insider selling, and the absolute magnitude of those moves is much larger as well following a wave of insider buying versus selling. We found that the number of positions that we carry at any given time generally varies from somewhere in the mid-30s up to the low hundreds, depending upon the degree of insider activity across the market at a particular time. So, for example, in a time like March of 2009, you would have seen an enormous wave of insider buying where they timed the low of the market extremely well, where we would have been able to diversify the portfolio pretty much across the market to a lot of companies where there were examples of this type of activity, whereas more recently there's been more normalized insider buying versus insider selling, where we have a portfolio of about 43 long positions. And it actually depends on which one of our portfolios you look at, because we do one mid-cap and large-cap version of the portfolio that has about 40-some names, and then we do another portfolio that's all-cap, which includes small to micro-cap stocks, where there's up to about 150 stocks on the long side in that portfolio and similar number of short positions.
Related to that, have you found that the strategy has better performance in the small micro-cap space relative to the larger cap companies?
Absolutely. We've seen there's almost double the alpha to small and micro-cap companies that have dramatic insider activity versus what you would see in large cap firms. Basically anything you can think intuitively about insider activity, for the most part, we have found to be true. And that's especially true in small to micro caps, largely because when you have very little analyst coverage and very few institutional investors analyzing a firm stock, nobody really knows what that stock is worth, like the executives of those small firms. So the stock price can vary dramatically from true intrinsic value, whereas at a larger company like an IBM per se, there's going to be 30 analysts, and all of Wall Street's going to be carefully analyzing where that firm's earnings are going, whereas you have a very small group of people who actually have an insight into where the upcoming earnings for the next quarter or the next several years will be at a $100 million biotech company, for example.
And how about some pitfalls related to the strategy? Perhaps one thing that comes to my mind is if we look at, and I think you mentioned the period in March '09 as an extreme, or if we take the other extreme of, let's say, mid-2007 when everybody's bullish, do you make any adjustments, let's say, for how to handicap, let's say, executives and adjust for perhaps the fact that at a certain time executives are just very, very bullish or very, very bearish as a whole, and you kind of feel you need to adjust that in your strategy?
So we do adjust that in our strategy, but the other way around. What we found is that obviously, like a year like 2009, they had great timing, and whereas the investing public had pretty particularly bad timing in 2007 in particular, especially in financial stocks. Insiders as a whole had outstanding timing when you looked at them and averaged their activity across the board, whereas there was extreme insider selling in financials in 2007. So we take that into account in our strategy, and essentially the way we do that is we'll manage it through option positions, where we'll do out-of-the-money call writing to give ourselves further potential upside when there's a heavy wave of insider buying across the market in a macro fashion, whereas when there's heavy insider selling across the market, we'll adjust for that by writing in-the-money call positions against the indices in order to hedge out any potential drop in the market. So we're really just capitalizing on the differential between insider buying performance versus that of the market, rather than actually needing the market itself to go up to make money. The real core behind our strategy is trying to be neutral to market activity as a whole, but be more focused upon the alpha of insiders relative to where they're buying versus where they're selling, rather than having to predict where the market itself is likely to go in the near future.
So would it be right to say that based on your experience and back testing, that whereas you may get a very bullish executive in mid-07 who thinks he can, let's say, sell his firm in a cheap financing environment, and then the market crashes, and you can get a very pessimistic executive in March '09 who sells the shares, the overwhelming evidence is that if you follow the insiders, you'll do well.
Right. So the information is very indicative, and the statistical studies we've shown most individual years that there's a 99.8% probability that insiders are outperforming in a fashion that's not driven by chance. And you could increase that if you were willing to change the confidence interval a little bit. However, to clarify, we have not found that individual insiders are particularly prescient if you just look at one person at a time. We found that you need to be looking at examples where they're all acting simultaneously in the same direction. So if you see a CEO is buying stock in his firm in a big way, but the CFO is selling in a heavy fashion, the COO is selling in a big way, it doesn't really mean anything. It's really those stocks where you see that there's unanimous activity across the board where they're all buying or they're all selling with their own funds. That's where you get a great signal. And even in those individual companies, you don't necessarily get a great signal in any particular example. However, if you look at all of those signals in aggregate in any given year, it's not even that insiders will be right and that the stocks that they're buying on average will go up. But what you will find remarkably consistently is that insider buying across the board will very consistently outperform insider selling across the board. So if you simply build a hedge portfolio, even in a year where insider buying stocks go down, it's very likely that stocks that have heavy insider selling will be down more. So you just need to make money on a relative basis, not on an individual basis where they aren't necessarily going to be right.
And with U.S. markets nearing record highs here, what does insider transaction activity tell us more recently? What are insiders as a whole doing?
So what we found across the board for insider activity is that when insider buying is in the top quartile of what's normal across the market, the probability of an up year following that type of activity is about 72%, whereas when insider selling's in the top quartile of its normal activity, the probability of an up year is only about 51%. However, the big differential is in the absolute magnitude of the moves, not so much in the probability of an up or down market. Whereas following a big year of insider buying, the average up move is dramatically larger than an up move following year with insider selling. And the average down year following year of heavy insider selling is much larger in aggregate than the typical year where you have insider buying and the market's still down. So what we've seen recently is that insider selling is a little bit higher than normal. It's not all the way into one of the unusual quartiles. So you don't have a great signal right now one way or the other. You have an expected value for the market following year subsequent to what we have right now, somewhere in the 5 to 6% type of range with a close to even probability of the market being up versus down, about a 53–54% probability of the market being up given the recent activity in the subsequent year.
And we have a global audience here on the conference. I'm curious if this just applies to the U.S. market or you've tested this also in any other markets.
We have not tested this in other markets, but there have been academic studies in other markets where they've essentially found that in Latin America there isn't really any alpha to this type of strategy, primarily because of differences in disclosure requirements. There was a particularly good study in the Netherlands that had similar findings where there are similar disclosure requirements, where there was a good degree of alpha, and it's really driven in large part by the regulatory environment in that individual country. Countries where they have a regulatory environment for insider activity like the U.S., you're probably going to see similar alpha, and countries where insiders just trade and don't bother disclosing anything, you're not going to see any alpha in large part because there's no place to really look for those transactions.
And just curious, for anybody interested in learning more about the strategy or any resources, do you still publish anything on your website that you can refer people to who are interested to learn more about it?
Sure. So we run a monthly newsletter called Catalyst Insider Spotlight, where we do updated calls once a month on companies that have the most recent heavy insider buying or recent heavy insider selling. You can sign up for that via our website, catalystmutualfunds.com, or we also do a monthly call for our investors where we update them on the stocks that have the most recent insider activity in substantial fashion as well.
David, thank you so much for all these insights, fascinating presentation and these takeaways, certainly a lot of food for thought, and thank you again for your time.